perspective. But before we do that, I'll turn it over to Mark. If you could address what you're hearing from lenders specifically in terms of what is the art of the possible.
Yeah. Yeah, thanks, Ryan. Obviously there's been high interest in the sector from private equity over the last several years, and in turn, high interest from lenders. And so virtually every private credit firm out there has some exposure to the PPM sector, the DSO sector. And that interest has driven enterprise values high, and that's certainly been supported by high debt levels. And as you mentioned, around the assumption that these were largely insulated from macroeconomic factors. And obviously that's been proven not to be the case. And so during the stay-at-home periods here, we've had leverage levels that were already high become higher, while at the same time, leverage levels that lenders in general are looking for in the market have at best come down a little bit, and perhaps certain sectors come down even further. And so you've had leverage levels for these businesses moving in the wrong direction. And the conversations that I've been involved in with the distressed businesses generally start with some sort of a refinance. How can we refinance out our existing lender? And it's in these situations, there truly is no debt for debt solution. And I think people are beginning to realize that we're not going to be able to simply take a LIBOR 550 deal and replace it with a LIBOR 750 or 800, or pick the interest rate. That solution just doesn't really exist. And so then you start moving down the capital structure, and there's certainly been a number of structured equity, flexible equity firms that have come into the market over the last 36 months, and many of them raising incremental capital here in the last 6 months. And that is certainly an option, and it's something to be considered. At the same time, through our transaction experience here at Livingstone, we've definitely seen that as you factor in some sort of a pick rate and then the structure features, whether that's a liquidation preference, warrants, et cetera, the all-in economic cost of that junior capital can sometimes be a little breathtaking, especially to private equity owners. And then you layer on top of that some of the requirements for control that may be coming from these minority investors. And at times it's proven to be a tough pill to swallow, and has forced people to explore incremental options. And so then what we find happening, I think, as you suggested, is the art of the possible, which is a phrase we've probably heard more in the last 2 months than we've ever heard before, becomes let's look for a more comprehensive solution, or let's evaluate all the options on the table and what actually can be done given the situation that a business is in.
Thanks, Mark. And I think that's why we believe we're well positioned, to advise clients on that comprehensive solution by being able to bring that healthcare expertise with debt and special situations capabilities. But Mark, maybe I'll turn it back to you again in terms of when the time comes to approach those capital markets, given that businesses are restarting and may or may not be back to some level of normalcy pre-COVID, how much runway do borrowers or your clients require in terms of trailing performance in order to get credit, if you will, from the lending community?
Yeah, it's very industry specific, and I think it's actually still evolving as well. We're learning real time. Joe and I are working on a couple of situations for businesses in various states of distress, one more of an industrial exposure, the other in the healthcare services sector. And for that industrial business that's participating in a more complicated supply chain, probably a view that the macroeconomic cycle here could impact the business longer term, we're recommending 2 to 3 months of positive performance before we take that business out to potential investors. And on the flip side, for a healthcare services business that we're working on, that we're measuring that more in a matter of weeks. The green shoots, the revenue cycle is a little more straightforward. Patients are calling in, making appointments, showing up at the door, and so you can start to get comfortable that demand is coming back a little bit quicker. I know Jim, through a recent transaction, has some very real-time experience with this.
Yeah, thank you, Mark. We recently closed a healthy autism deal just 2 weeks ago. Through our process, they had performed very well up through mid-March. Ultimately, volumes dropped, and this was a home-based autism business. Volumes dropped about 40% by late April. And then each week, and we were looking at weekly hours billed, from late April, they started to increase. And ultimately by mid-June came back to about 95 to 100% of pre-COVID levels, as again, parents were more comfortable having therapists come in to treat their autistic children. We ultimately, from mid-June to about mid-July, had about 4 weeks of performance that got the buyer comfortable. And again, then we moved to a close. So that's just one example with the kind of visit or hour and revenue per visit or revenue per hour model that buyers can get pretty comfortable. Of course, they were already comfortable with the demand dynamic within their local market.